If I regret something in the past, then part of me wonders, like, if I hadn't done that or if I hadn't gone that direction, would I still be in the same spot that I am today? And so that's why I don't like having any regrets. The things that I did, the steps that I took are, led me down this pathway to this point.
Alrighty, hello everyone, and welcome to the Deal Maker Show. So today we have an amazing story. An amazing story where we're going to be covering all of the good stuff that we like to hear. The building, the racing, the scaling. I mean, on their end, they did this crazy pivot. That really propelled them to an absolute rocket ship. We're going to be talking about perhaps those times, the ups, the downs. Not making payroll. Last minute, craziness, term sheets being pulled. Again, a lot of adrenaline and a lot of inspiring conversation that we have here in front of us. So without further ado, let's welcome our guest today, Jon Lensing. Welcome to the show.
Thank you, Alejandro. Appreciate you having me on.
So originally born and raised in Iowa, give us a walk through memory lane. How was life growing up for you?
Yeah, you probably don't hear many tech founders from Iowa, but grew up out in the country on a gravel road. Um, grew up on a small little farm with some livestock, corn, soybeans growing around us at all times. Small town, about 400 people. Had to drive about 20 minutes away to go to school, and that city where my school was about 10,000 people. My graduating class is about 65. So, small town America, gotta love it.
And how do you get this I would say like this spirit, this ambition, that you have? Because I mean, when you are like in a small town, not a lot of people, perhaps like you don't get to think as big, because of the people that you're surrounded by. So what do you think has fueled that ambition that spirit that you have and that mindset?
I think the ambition comes from everything you said. It's small town. The pond is smaller. There might not be as much ambition around, and I wanted to change that. I wanted to put Iowa on the map. I wanted to give back to my home state. I wanted to figure out a way that we could build the next, publicly traded company right here in the Midwest and show that it can be done anywhere. It doesn't have to be done just in San Francisco or just in New York, but there's a lot of great opportunities and companies that could be built right in the heartland.
So then, how do you get to, obviously your dad was a physician, OBGYN, and you decided to go into medicine, I guess following the footsteps. So walk us through how that evolves into all of a sudden, becoming an entrepreneur. It's quite the sequence of events there.
Yeah, it's interesting. Like you mentioned, my father's a physician, was a physician. He's retired now, but he strongly urged us kids, I have three other siblings, to not go into medicine. So far, two of us have not listened to that advice and gone into medicine, me being one of them. I just enjoyed science. I enjoyed working with my hands. I enjoyed physics and math, and becoming a physician was, sort of the logical step to combine that with the other side of just helping better humanity. I liked that aspect too. So it was a very clear path for me. I ended up going to school up in Michigan, studied sciences up there at a small school called Calvin in Grand Rapids, Michigan. Came back then to the University of Iowa for medical school, progressed throughout my studies there, fell in love with surgery, planned on going into plastic and reconstructive surgery right after medical school. And post graduation, I actually yanked and dropped out of going to residency. So graduated medical school, but then discontinued further clinical training, and that's really because of OpenLoop. OpenLoop had started off in the last few months before graduation as a passion project. Really trying to think about how do we help rural America get better access to healthcare. During my time in medical school, I was seeing patients drive 3, 4, 5 hours one way to come in and get the care that they needed. and they would just delay that care for so long. And so they would come in so much sicker because it was such a hassle to make it there. Right, they're from towns of 100 people, 200 people, no stoplights in their towns. And so OpenLoop had started off as like, how do we help get these small communities better access to doctors, to nurses, to therapists, these healthcare providers they desperately need. And my plan was just keep it as a passion project, keep running it on the side throughout the rest of my clinical training. But what it morphed into over the span of a very short few months was we started generating revenue in the business. We started doing close to $50,000 to $100,000 within the first few months per month, and we started putting doctors in these rural areas, putting nurses in these rural areas, and really making a difference and helping. And so I said, okay, hey, I think there is an opportunity here. Um, let's jump into this full time. I think I could have a much bigger impact on healthcare by building this business than I could just by being a solo practitioner in medicine. So, after graduation, jumped into this full time, and it's been 4.5 years since then.
So I guess for the people that are listening to really get it, what ended up being the business model of OpenLoop? How do you guys make money?
Yeah, so the original model was just staffing in person clinics and hospitals, and we took a cost plus type of approach. Cost of the clinical labor, mark it up by 25, 30%, and that was our take. What was interesting, and you alluded to it at the beginning, is because of COVID in mid 2020, our original business pretty much went to zero. We couldn't sign any new contracts. I couldn't get in touch with hospitals. Our previous sales cycle before that was averaging 45 to 50 days. It was really quick. But, once COVID was really mainstream, like hospitals didn't want to have any of those conversations anymore. We just could not sign anybody new. And so we had a hard pivot 180 degrees into the digital health space. And, we did that because of COVID, telehealth was just booming and skyrocketing. All of these companies that were doing telehealth needed clinical labor. And so we applied the same sort of business logic, match the supply to the demand, except now do it within the digital healthcare ecosystem. And that pivot, was trajectory changing for the business. But with that, we sort of, shifted ourselves, molded ourselves to become more and more vertically integrated in the space. And so, now our business model is sort of on a per patient per month sort of structure.
I
Business
mean
model.
that the pivot is quite nerve wracking because, as you mentioned, you guys already were generating really good revenue. I mean, as you said, obviously COVID impacted things, but you guys were able to see, hey, we're able to create something meaningful here. Doing $50,000 to $100,000 a month is impressive. So when you guys did the transition of the pivot, at what point do you realize, I think we may have gotten this right?
That's a really good question. I would say, we knew within the first 2 months of making the pivot that we got it right. And that was because every single sales conversation we got into, there was immediate feedback of like, when can I sign this contract? How quickly can you guys get up and running for us? And I mean, we were talking, we were getting some of those early contracts signed within like 48 to 72 hours. And so we were revenue generating from some of those contracts within, 10 to 12 days of signing a contract. And I think we went from zero contracts in the digital health space to getting like 15 to 20 new clients in the span of like 60 days. And that's sort of when we knew like, wow, like this, there is a market here. We need to be putting more and more of our efforts and just relinquish any of the hospital and in-person stuff.
So obviously, there's not such thing as a straight line, and there's been ups, there's been downs. But I remember one of those stories took place on a Thursday evening, and it could have been the end of the company. So tell us what happened.
Yeah, so this was a couple years into the business. It was either late 21 or early 22. I cannot remember now anymore, but I remember the evening. It was late Thursday evening. We had about 50 to 60 full-time employees at the time. And in the morning, we were supposed to send out payroll. We didn't have enough money in the bank to cover payroll that next morning. And we had this term sheet sitting there from a big venture capital group. That was a prior investor into OpenLoop. And the term sheet was for an $8 million raise. This group was going to put in 4 or 5 million of that. But I didn't like the terms. The terms were slightly unfavorable to us, and I wasn't sure about the group either, if they were the best fit for us. And so because of that, I waited until the last possible minute, and I think the term sheet expired at midnight on Thursday evening, Friday morning, and I signed it at 11:55 p.m. I just stared at that on my computer from the time business closed at like 5 p.m. until 11:55, and finally signed at the last minute. Sent it back in the next morning at like 6:30 in the morning. I get an email from the group saying, "Hey, we actually decided we're not going to do this deal. We're pulling the term sheet." And so, I woke up that morning wondering what the hell we were going to do. Payroll needed to be made in a few hours. Otherwise, I was going to have to let the entire company go. I called up one of our board members. He said, "Hey, look, I have full faith and confidence in you guys. I've already invested into this business. I think you guys will figure out a way to make it work." And so he said, "Here's a $200,000 check. Go cash it this morning, make payroll, and we'll figure out the investment side of it later." Thankfully, that all worked out. I walked into the business at 8 a.m. As soon as it opened, I cashed that check and we made payroll and we saved the company at that minute. But, hundreds of stories like that just throughout the rest of the business. But that one is it's the most visceral. I remember that one the deepest.
What do you think you learned from that one when it comes to, being able to be the best version of yourself? I guess to be able to quiet those voices that are telling you the what ifs, that really make you ineffective. How did you go about that?
There's a lot of different pathways that one can take to get to the desired endpoint. And there's a lot of trajectory changing nodes within that journey that can propel you on a bunch of different directions. I think for us, some of the key things were finding partners for our business that from day one resonated and believed in the thesis of what we were trying to construct. It's really difficult to make a square peg fit in a round hole. With this investor that pulled the term sheet, like even though they were a small early investor and wanted to lead a larger second round for the company, they didn't fully grasp what we were trying to do. They didn't fully grasp the vision. And so it was a bad mismatch from the get-go. I think it was 2 weeks after that, we ended up having an investor come in who led the round at better terms because they knew, from day one, even before meeting us, they had a thesis on the exact company that we were trying to build. So from day one, it was a matchup, full strategic alignment on that. And then I'd say the second piece of it is outside of just choosing good partners is you have to be, you always have to have your ears to the ground. You have to have your ears to the ground in terms of where the market's going, how conditions are shifting, but then you also have to have an ear to the ground and what are your clients saying? How are they responding? And then you need to be able to triage all that information and be opportunistic about the potential avenues in front of you. If I had just stuck from the original product idea and straight lined it through, we'd be nowhere near the traction and size that we are today. But, we listened, my co-founder and I, to what our clients were saying. Once that hit enough density, we added in some of those service lines and we built that feature into the product, et cetera. Or we had a gut feeling based on listening to the markets of, hey, we think this is coming in 6 to 12 months. Let's start building this sort of piece of the equation that we need to be able to deliver for what we think the market's going to bear in 6 to 12 months. And being opportunistic about those pieces, I think we'd probably be a 20th the size of that we are today if we didn't listen to those things.
So in total, you guys have raised to date 120 million, give or take. And I heard that the valuation is north of $1 billion, which is pretty impressive. Now that you're looking back and you're able to see all these different financing cycles that you guys have gone through, what would you say the journey has been and the experience of going through them?
Not all capital is created equal. Let's put it that way, right? There's during the early stages, you want capital to be more passive. Um, because during the early stages of a company, you might go through 3, 4, 5 pivots until you really find product market fit. You may need to reconstruct your product from all the way back down to zero and rebuild it to enter a new market that's going to resonate better. And so, if you have too active capital at the beginning, they can help dictate and push you down strategies that might not actually work. Now, in the later stages, once you have some early product market fit, having more active capital becomes really important. Um, an investor with a really good network is worth 10x, just the capital that they put in. They can open doors for business development opportunities and, add $100 million of revenue to the business with their connections. On the strategy side, they can help help dictate like, hey, here's a brand new market. Have you guys even thought about this? And then follow on capital. Like if you're trying to build an absolute rocket ship that's going to capture as much market share in as short of amount of time as possible, you're likely going to need follow on rounds of funding. And making sure those investors have connections either from their own pocketbooks, their own funds to follow on with additional capital, or that they're very well connected to Series B, Series C, Series D, growth equity, pre-IPO investors, IPO investors, if that's the route you're going to go. Making sure that they have those connections. But outside of those tangible things is the intangible stuff. You want to make sure that they're sort of cut from the same cloth that you as founders are. Do they share the same ethos? Do they share the same like ethical and moral backgrounds as you? Are these people going to support you in the times of turmoil as well as the great times? Do they trust you as a founder to direct the overall vision of this company? And in surgery, in medicine, when you choose sort of when a surgeon chooses their nurses or their physician's assistants to assist them in surgeries, you want to think about like, can I stand across the OR table with this person for the next 8 to 12 hours of surgery? The same thing happens within a startup. Like when you choose your investor, it's like, can I be in a relationship with this investor for what might be the next 7 to 10 years of my life, the most stressful times of my life? And so, being eyes wide open when you're choosing that capital, where you take that capital from, incredibly important to remember. It's going to be a roller coaster down the road, and you're going to be locked in with this person for a number of years.
What's one question that you would typically ask an investor to help you in filtering the good from the bad?
Investors are salespeople at the end of the day. They'll sell you on a lot of different stuff, and they'll say what you want to hear. I would opt to go do reverse diligence. Don't ask them for references, but go to their website, figure out who their portfolio companies are, and go find those founders on LinkedIn, connect with them, and ask them for a background on that venture capital group. And I would always strongly suggest that people find a group that hasn't had success, right? Like a portfolio company that didn't work out the way that everybody would have hoped, and see how that investor responded to them in that time of stress and chaos in a lot of ways. Other than that, I prefer to spend an entire day with investors. I want to know them on a personal level. I want to know their upbringing. I want to know how they got into their position in their career. I want to know what makes them tick. And again, I want the same sort of DNA that we're made out of. Like all of our investors to date, the majority of them sort of had this Midwestern ethos. Like they're young investors. They might be in their first or second fund. They have a chip off their shoulder. They have something to prove, and they need to make things work out for them. It's the same thing with us here at OpenLoop. My co-founder and I, it's our first large scale endeavor. We don't make much money from it, from a salary. We're not independently wealthy because of this. And so the only thing that we have for ourselves is OpenLoop. Like, we need this to succeed, and we'll do whatever we can to make it succeed. And that's the same thing with our investors. Um, so, that's what we look for.
So making it succeed. Let's talk about this because obviously investors too, they're betting on a vision, and same for customers and employees. So if you were to go to sleep tonight and you wake up in a world where the vision of OpenLoop is fully realized, how does that world look like?
If I were to wake up in 10 years from now, Alejandro, I predict that the majority of healthcare is done virtually. 90 plus percent of it is done virtually, and it's done passively. And what I mean by that is, gone are the days where you'd have to schedule your quarterly or annual or semi-annual visits with your PCP and go in there and review your health. But instead, we're going to have so much technology in the next decade, from wearables like the Oura Ring, Fitbit, Apple Watches, smart mattresses like 8 Sleep, the Samsung smart refrigerator, all the cameras that are in people's homes, so that so much data collection is happening passively that we know individual patients at a very personalized level. Like, right, Alejandro, we might know every morning you step on your scale, so we're trending your weights. We have all of the information from the Apple Watch that you're wearing. We know how well you sleep. We know what kind of foods you're eating based on what's coming and going out of your refrigerator, your credit card hooked up, where you're spending your money on food, etc. We know those things, so that instead of tweaking your health profile on an annual or semi-annual basis, we can now tweak it on a daily or almost hourly basis. We can push you notifications to your phone like, hey, you haven't had enough water today, or hey, we noticed that over the past couple of weeks, you've been eating more and more fast food, and you've been sleeping less. Your stress levels are high. Let's walk through some breathing exercises. Let's do some AI therapy and coaching to get you back to a really good baseline. And then more so, it's so personalized that we can send you every single week sort of the supplementation and medications that you need. I could tweak your statin medication. I could tweak your beta blocker for your heart conditions on a weekly basis, depending on how you're responding to different things. And if that all comes to fruition, what I hope OpenLoop manifests itself in is becoming the operating system to enable all of that real-time care to patients. That, taking all that passive data collection, turning it into actionable insights, pushing that back out, and making sure that care is actually delivered then to the end patients.
So that would be a beautiful world. And obviously, working towards that, you guys have been growing like crazy, 5x, and north of that on a yearly basis. But obviously, with growth, it comes breaking things too. And I remember there a story that you guys got of 2023 in particular, which involved, we're talking about people, but involved employees, and it was not so fun. You guys were waiting on a few contracts, and that kind of like threw everything, off. So what happened there, and how did you guys work towards, really embracing culture and come out of that stronger?
Yeah, with every sort of company, you're always going to have hiccups along the way. There will be times of pain amidst the times of great success. And, one of them was early 2023. We were starting to sort of hit hockey stick growth that you want to see. We had signed some really large accounts with some guaranteed minimums in it. And so we felt very comfortable hiring for those contracts we just signed. So we went on a pretty large hiring spree, added, 100 to 120 people into the mix, maybe even 200 now. I can't remember. But those contracts were delayed. They every single month they'd be like, no, this is the month. This is the month. But then that month would come and go and no volume would materialize. And even though they had contracted monthly minimums that they're supposed to be paying us, they weren't paying them. And so we got to a pretty difficult decision, a few months after signing these contracts, that we'd have to let, about 50 to 60 people of that group that we just hired go. horrible experience. I personally did those layoffs. It was one of the worst days of any founder's life that you go through with those, because those people trusted us. Those people, I had a lot of loyalty to them because they took that risk on us, an early stage startup, and it just didn't pan out, unfortunately. So we ended up letting those people go. And then, I guess the silver lining out of all of it is, about 4 months after we let those people go, those contracts materialized. The volume happened and came, and I was able to take a significant number of those individuals that we hired for those contracts and find different places for them in the organization over time. But still, highs and lows always. It's a roller coaster of emotions.
So, and also in that regard too, I mean, how do you go about the culture, and making sure that that things are done well? Because at the end of the day, the facts are always the facts, but the way that you deliver them and the way that you react towards them is really what matters. And I'm sure that people took notes. So, how did you go about that to make sure that the culture in the end, was embraced the way that it needed to be?
Culture is really difficult, Alejandro. You can try and say to make culture whatever you want it to be, but culture is stemmed from the operating ethos of the people in it. How do the top level, the C suite, the VPs, the directors, the managers, all the way down to the individual contributors, how do we all function as a unit? And that's the output of that is what culture will become. As a culture, as an organization, the things that we respect and we reward in the business end up becoming the ethos of that business. And so for OpenLoop, our culture is not for everybody. I think Reed Hastings, famously had a slide in one of their decks saying that, Netflix's culture is not for everybody either. Very few people will succeed here, but those that do are going to love it. And I ascribe to that same sort of mentality. The culture here is one built off of, competence, ownership, and grit, just straight up perseverance. The people here need to be able to digest massive amounts of growth. So working in the business to execute on that growth, but they also need to find and make time in their schedule to work on the business. What are the next 3 to 4 to 5 strategic things that we need to do to continue up leveling at the same pace that we're on? And so sometimes that can create a stressful environment for the wrong folks, and can create some friction. But the analogy that I always like to use with my team is, while operating the core business is your fundamental duty, you still need to reserve 25 to 30% of your time to work on the business and the new strategy. And so we always have 20 to 30 other projects that are in the wings, things that we're testing. If we don't like the test, we'll discontinue working on it. If we like them, then they become new products in the business, new core services in the business. And trying to operate the core business, but then also find time for the strategy, it's stressful. And so the analogy, like I was mentioning, that I use is, if you do any sort of cooking, you'll know that the best tool that you can have in your armory as somebody who likes to cook is a really sharp kitchen knife, for prepping vegetables, cutting meats, you name it. And for those that know, the only way that you keep a knife sharp is you put it to stone. Right, you put it through a sharpener, and it's abrasive, it's friction inducing. That's the only way you keep a knife sharp. In much the same way, if we don't have some of this constant external stress on the business, these new projects, these new things that we're testing, that means we're not going to keep our knife sharp. We're not going to keep innovating. We're not going to continue to remain disruptive, and we will lose our edge in the market. So I think people understand that, and that's sort of the culture that we've built. One that strives to deliver the highest impact service we possibly can, while being one of the most innovative and disruptive companies in the healthcare space.
I love it. I love it. So, John, let me now put you into a time machine, and I'm going to bring you back in time. Let's say it's that time where you were thinking about making a move and leaving behind, your career in medicine. And let's say you're able to show up right there when you're about to really make that call, and you're able to give that younger John one piece of advice before starting a business. What would that be and why, given what you know now?
Very few, if any, regrets, Alejandro. Mainly because if I regret something in the past, then part of me wonders, like, if I hadn't done that or if I hadn't gone that direction, would I still be in the same spot that I am today? And so that's why I don't like having any regrets. And the things that I did, the steps that I took are, led me down this pathway to this point. Instead, reframe your question slightly is, when I meet with some really early people thinking about jumping into entrepreneurism, um, and they ask for advice, I say, I just, the most simple advice that I possibly can is, if it's calling you, like, you got to do it. Entrepreneurship is not something where you dip your toe in the water, see how it feels, and slowly get in. Like, if you want to do it, you got to give it everything. You got to jump both feet in the deep end, dive in head first, and just go for it. Some of the most painful experience that I've seen with founders, entrepreneurs, are those that try to, have one foot in, one foot out. How do I have the safety and security of a really good W-2 job, but then also try to make it on as an entrepreneur? Like, you're serving two masters then, and it doesn't work out. There are exceptions to that case that I've seen people who have made it work, but the most successful are hell bent on the vision that they have, the passion the passion for the company that they want to create, and they go at it with 110%.
I love it. So, John, for the people that are listening that would love to reach out and say hi, what is the best way for them to do so?
Shoot me an email. My email is pretty public. It's Jon, Jon, at openloophealth.com. I'm on LinkedIn, Jon Lensing. Find me. Let's connect. Let's chat.
Amazing. Easy enough. Well, John, thank you so much for being on the Dealmaker Show today. It has been an absolute honor to have you with us.
Appreciate it. Thank you, Alejandro.